Last week I said, so where are we now? Well, where are we now? The bottom forming indicator is moving higher. You can see that the S&P 500 declined a little bit on Friday, and the risk confidence is falling here. So my prediction for next week, we're going higher. And you can see that's almost exactly what happened this past week, with the exception of small caps. So why are analysts, except Tom Lee and Casey Mulligan, starting to squirm?
The first jobs report, jobs of 24 is out, and it is whopper 353,000. 353,000. We have to go in the Wayback Machine. That is the biggest non-farm payroll gains since January of 23, when it was 472,000. And if we look at the unemployment rate, it is 3.7. It's remained at 3.7. And just for history's sake, the 3.4 low that we had was the lowest since 1953. That was in April of last year. If we look at the average hourly earnings, a huge jump, up 0.6%. Up 0.6%. It equals March of 22. To find a higher number, you have to go to January of 22. And also, for some context there, the amount of year over year is also popping 4.5%. We were expecting 4.1. The year over year average hourly earnings began as a data set in 2007, pre-COVID, all the way to when it started. The high was 3.6. It's 4.5. 4.5 is the highest level going back to February of 23. Yes, hello, a very important guest. This is Casey Mulligan, economist, professor at University of Chicago, and he was chief economist under the Trump administration with the White House Council of Economic Advisors. Welcome, Casey. Beautiful trading floor, isn't it?
I love this, Rick.
All right, so today we had this whopper of an employment report, 353,000, up 0.6 on average hourly earnings. If you look at year over year, up well over 4%. But I noticed the work week took a drop to 34.1. And outside of COVID, that's the smallest work week in 14 years, and the data series started in 2006. Thoughts?
Anytime you have an outlier, that's subject to revision. Expect them to revise that. And that also has an effect on the wage because, of course, they're taking the earnings divided by the work week to get an hourly wage. So that's an outlier on the upside. I think we'll see those both revised more normal.
History has shown us that a strong jobs market combined with productivity gains doesn't result in high inflation.
Tell me what's going to happen then.
Well, I think 2024 is going to ultimately be a good year for stocks because we've got a Fed that's no longer fighting an inflation war. And we know that the ISM manufacturing, these PMIs are bottoming, and that's correlated with earnings beginning to accelerate. And we know there's pent-up CapEx. Capital spending's been sort of held back for the past few years. So that accelerates. That's good for earnings. And we expect mortgage rates to fall, which would be good for consumers. So it's really going to be a good year for stocks.
With all that, let's take a look at how the equity, bond, gold, and crypto markets are looking right now. Now, I normally don't show just one day on here, but we're looking at this past Friday, and you can see that the jobs report, the very hot jobs report, came out early before the market opened, and you can see that ARK Invest, small caps, and even the Dow started out the day gapping down a little bit lower, while the S&P and the NASDAQ 100 started an upward move. But as the day wore on, you can see what happened. Everything finished up except small caps. And how does this all look over the past week? Well, over the past week, you can see that we had a very nice run up on Monday. Then things pulled back going into Wednesday and Thursday, and then they started to rally again. So for the week, everything finished up except the small caps. So this is a fairly healthy looking equity market, with the exception of small caps, because when long yields or yields in general go up, then, value investors put the risk-free rate in the denominator of their value equation, and that makes the value of these smaller caps go down, which I think is total foolishness. And you'll see how the yields for Treasuries went up on Friday in reaction to the strong jobs report when we look at the data for Treasuries. And how do we look over the past month? Well, over the past month, we have a pretty healthy looking risk appetite here. NASDAQ on the top, S&P second, Dow third. Now, small caps are kind of flat and in the middle here, and ARK Invest is at the bottom. But you can see that ARK Invest seems to be kind of going sideways to slightly up here. So I think this is possibly a good sign for ARK Invest going forward. And if we look back over the past year, you can see what we've been through here. A lot of gyrations up and down. But you can see that the NASDAQ is still on the top and heading higher, followed by the S&P 500, followed by the Dow, followed by ARK Invest, and small caps are right down here with a small loss for the year.
I'm afraid to say how I feel.
And what are we seeing in the current bottom dynamics? Well, if we look at this, we've got a rising market. The S&P pulled back here a little bit, but then went up over the last couple of days. You can see that this bottom forming indicator is moving higher. This typically happens as the market goes down, not up. And you can see the bottom confirmation signal is moving lower. And then you've got risk confidence, which really collapsed here, but is now increasing. This is a tough call. I mean, if I were just looking at this increasing risk confidence and falling bottom confirmation, I would say we could see a softening next week and possibly go lower. I'm kind of a little bit reticent to call that, though, because the market was moving higher over the past couple of days. Now, when it comes to safety confidence, which I don't normally talk about, this moving higher here as Treasuries fell gives me an indication that they could go lower, but I'm not usually one to call Treasury direction. So I'm not going to. Let's see what happens with this next week. And how does this all show up in risk versus opportunity? Well, really kind of nothing to see here, folks. I mean, you've got the opportunity level, which kind of fell back here as the S&P continued higher. So that's a divergence. That's scary. But then risk opportunity started to move higher here, and it's above 60. So it's in a place where I'm really not concerned. And if we look at risk, the red line, you can see it's way down here at less than 10, nothing to look at. And risk acceleration, while it started to increase here, pulled back a little bit on Friday. And again, it's at a very low level, below 30. So really nothing to be concerned about.
Don't wanna let you down.
And what about equity versus safety? Well, let's take a look at the NASDAQ and small caps and cash to kind of get a sense of what's going on here. So you can see where bonds, long bonds, crashed back here. And you can see that cash shot up to number one. But where are we now? Well, the NASDAQ has moved up solidly into first place. This looks great. And small caps, which have really been waning here, moved up from 10th to 5th place. And by the way, the Dow and the S&P 500 are in second and third place, and cash is moving down. This looks really, really good. Now, what if we focus in on Treasuries? So if we take a look at the picture for Treasuries, interesting here. You can see where yields really shot up and bonds collapsed back here. They tried to kind of move up here, but now TLT and EDV, the two most risky Treasuries because of their very long durations, are right down here at the bottom. So we still have an appearance of an unhealthy Treasury market. Now, what's interesting about this, though, is SHV just fell below IEI. So SHV are short-term Treasuries, IEI are intermediate Treasuries, so they're a little bit higher risk. So this is starting to look a little more healthy, and if cash keeps coming down, that will be an improvement. But, like I said, it looks like Treasuries could soften next week, but this gives me encouragement that investors are starting to go a little bit further out on the duration curve, which could translate into these longer duration ones down here. How does all of this show up in the buying and selling pressure for equities? Well, you can see we've had a very nice rally in the Dow, but recently the buying pressure has been falling a little bit, this solid gray line, but it's still above the selling pressure, the solid orange line. What about the S&P 500? Well, here the buying pressure collapsed below the selling pressure, but the selling pressure is falling, the buying pressure is increasing, and the price is going up. What about the NASDAQ 100? Well, you can see we had a very nice situation here with the buying pressure well above the selling pressure, but recently they've been kind of noodling here while the price is going up. So I don't know what's going to happen with this next week. As I said, it looks like these could potentially soften. And then ARK Invest has really not gone anywhere. It went down. It's been kind of going sideways to slightly up. And you can see the selling pressure above the buying pressure here, but now they recently traded places. So this may take some time to play out, but we'll just have to wait and see. And what about small caps? Well, no surprise here that small caps pulled back, but what's interesting is they have been on somewhat of a rally here, somewhat of a tentative rally. You can see a very nice move upward here, big pullback, up and then down again. And you can see that the buying and selling pressure are really kind of switching places back and forth here. But on Friday, the selling pressure moved above the buying pressure and looks like it could be heading higher. But look, one thing I want to point out here is if we go back to here, while this was going down, the buying pressure started increasing, continued increasing as this rallied, and then started to fall back here while this continued going up. So we've got a lot of divergence going on here, and it'll be interesting to see how this performs going forward. Let's take a look at sector rankings. Now, remember, these take a long time to change. They're lagging indicators by far. And you can see that last week they showed that we had a healthy Treasury market, which we know we didn't. So this is what I mean by they lag. And you can see that we had technology and ARK innovation, Bitcoin up here at the top. I mean, this looks like a very, very healthy equity and Treasury risk appetite. Now, if we go to this week, you can see that 20-year Treasuries have fallen back, but Treasuries in general are in a healthy relationship. Again, we know this isn't the case. I like the fact that cash is down here. I like the fact that we've got technology in ARK and Bitcoin, more technology than NASDAQ 100 up here. So this looks like a very healthy appetite. Well, let's take a look at sector rank acceleration because these move more quickly and give you a bit more of a real-time picture of what's going on in the markets. And you can see last week, Treasuries were in anything but a healthy relationship with the long bonds down here, long to intermediates here, and intermediates up here. This is not a healthy Treasury market. You can see consumer discretionary down here, consumer staples up here. That's not really that great. And you can see that things like the NASDAQ 100 were down here in the lower half of this table. That's not healthy. And innovation, ARK innovation, all the way down here at the bottom. That is a very unhealthy look. Well, where are we this week? Well, if we take a look at this week, you can see that Treasuries have not really improved much, although these are starting to move down. This one, the highest risk one, is still stuck down here, so it's not moving up. Consumer discretionary stuck here. I like the fact that cash moved down a notch, and I like the fact that consumer staples moved from up here all the way down to here. That's looking pretty good. Let's see, what have we got here? NASDAQ 100 moved from down here in the bottom half of this table all the way up here into the bottom, let's call it 1/4 or 1/3 of the table. That's a very healthy looking move. Semiconductors are up here in second place. That's a very healthy looking move, considering they were all the way down here last week. So that's a big move by semiconductors. And where was ARK Innovation? ARK Innovation was down here at the bottom, and it moved down a notch. So that lines up with the graph that we saw. It really hasn't participated in the upward moves by the larger cap equities. And what about Treasuries? Well, this is a much improved picture from last week. You can see we had a very nice rally here until what happened? Oh yeah, we had a really strong jobs report here. And you can see the Treasuries just collapsed at the opening and then really kind of didn't go much of anywhere after that. Yeah, they dipped a little bit more and then started coming back. So it'll be interesting to see how this goes next week. You know, the equity markets shrugged off the jobs report, and actually most of them closed higher on Friday, as I showed you. So I'm wondering if we get into next week, if these could possibly continue rallying, even though I said from the safety risk confidence, it looked like they could possibly go lower. So it'll be interesting to watch how that goes. Like I said, I don't normally try to predict the direction of these. And if we look back over the past month, well, you can see what's happened here. The longest duration, highest risk treasuries sort of bottomed out here, really came back rallying, and then more recently on Friday pulled back because of the strong jobs report. So this looks healthy, and this is unhealthy. So it'll be interesting to see if this unhealthiness continues going forward. And if we look back over the past 1 year, you can see big picture what's happened. We bottomed out here, had an extremely nice rally here in the long bonds, a pullback again, and then a rally attempt until the jobs report. So interesting to see if this reverses and continues higher, or if it continues lower. And how does all of this show up in the buying and selling pressure? Well, you can see at the short end, these really were kind of rallying back here, and now we've kind of gone sideways to nowhere, and these buying and selling pressure indicators are not giving us much of anything here. They're just kind of noodling back and forth. What about intermediate treasuries? Well, intermediate treasuries, there was a nice jump in the buying pressure here. Then the jobs report came out and the buying pressure dropped while the selling pressure started increasing. But the buying pressure is still above the selling pressure. What about intermediate to long duration, 7 to 10 year treasuries? Well, here, this is actually a very healthy looking picture. You've got buying pressure way up here. Yeah, it pulled back, but look how much higher it is than the selling pressure, even though there was a big pullback on Friday. And then long bonds, very nice rally going on here until the jobs report. And look at the buying pressure up here at 10 and well above the selling pressure. Now it's pulled back, but again, still well above the selling pressure. So it'll be interesting to see what happens next week. Well, how about that inverted yield curve? Well, if you take a look, we're just about where we were a year ago. In fact, at the low end, we are just about where we were a year ago through most of it. We're higher at the very short end, but we're almost exactly the same up to 3-year duration. And then you can see what's happening here is the interest rates or the yields at the long end, at the 20-year end, the 30-year end, 10-year, 7-year, and so on, are quite a bit higher than they were a year ago. Now, what's going to cause those to come down is when the Fed starts lowering rates here at the short end, and that will uninvert this yield curve. But we're actually more inverted than we were last week. Last week, we were about 33 basis points inverted. Now we're 35 basis points, so a little bit worse. And how's the Fed rate monitoring tool looking? Well, you can see that we've got a little bit less likelihood that they'll keep rates the same in March than we did this month. But I think this is a higher likelihood than we had last week when I did this video. I'd have to go back and look. But now there's only a 20% chance in March that the market thinks the Fed might lower rates by 0.25%. Well, what if we go out to May? Well, if we go out to May, there's a bigger likelihood that they'll lower by 0.25%. And now you're starting to see signs that they might lower by 0.5%. What if we go out to June? You know where this is going, right? You can see that now there's a bigger likelihood that they'll lower by 0.5% and a small likelihood they might even go by 0.75% by then, and so on. And that's how it plays out through the rest of the year. So clearly the markets think the Fed is going to lower rates this year. From my perspective, they need to lower rates. They've left them too high too long, and I think they're going to get caught behind the curve here. And what about gold? Well, yeah, boring. You can see gold had a pullback here. It started to kind of rally, but you can see that the buying and selling pressure really isn't giving you any kind of a strong indication one way or the other. These are very low values. They just keep noodling back and forth. Now, all that said, the buying pressure is currently above the selling pressure, but it's falling. So I don't really have any idea where this is going. Now, what about Bitcoin? Well, Bitcoin looks good, actually. If you look at it, we had this huge spike back here where the ETFs got approved. Then everybody sold on the news. You can see that drop in the price here. And you can see that the buying pressure fell while the Bitcoin price was falling. Now what's happened? Well, since the bottom here, the buying pressure has been steadily increasing, and we've got a rally here. And currently, the buying pressure is nicely above the selling pressure, even though it kind of pulled back on Friday. So to me, this looks good. And I think, you have to take the longer view on these. There's a lot of adoption that has to happen here. There's a lot of proving that has to happen here. And these, while they could go to 100,000 very quickly, I don't know if and when that's going to happen. But I think this looks really pretty positive right now. Be really careful about the advice you'll find in articles and videos, especially if you're a new investor. Investments and investing aren't that complicated if you know how to allocate your portfolio without destroying your returns and getting little to no protection from downside risks. As an investor, you need to take the long view and allocate according to your risk tolerance, rather than fretting about what's currently happening in the world or what everybody else is doing that you read about in the media with their portfolios. If you want to be a better investor, I discuss how to allocate your portfolios in 2 key videos linked in the pinned comments below, titled The Ideal Portfolio Using Just 2 ETFs or Mutual Funds, and The Ideal Portfolio Using Individual Equities. Again, link in the pinned comments. Until next week, I'm Calvin Rose, and thank you for watching Invest Smarter. That's all for now.
Stay up all night, gotta work now. Make up my mind and it turns around. Say that I'm fine till I burn out. Thinking this money sounded so nice. Ambush here written in the strobe lights. Pay anything for the high price. This life feels like the sunny water. Wet my lips, but the sun is stronger. Pour it out, if I'm being honest. It's just not everything you promised. Running out, drying out, what did you say? What did you say when I told you? Maybe this wrist wasn't gold proof. Packing my bags like it's all true. Hard to make friends when I'm focused on all these bars that I'm holding. I like the cold, but it's lonely, yeah. This life feels like the sunny water.